Most of you remember that CFA Institute changed its mission statement in 2012. And the biggest change was only one line added to the bottom of our original mission statement, which says, for the ultimate benefit of the society. So we're talking about leading the profession globally in the area of ethics, education, and professional excellence for the ultimate benefit of the society. So when that was done, our board and our CEO at that time, which is John Rogers, talked about it and saying, what does this mean? And what are we going to do about it? So that was the genesis of Future of Finance, in terms of saying that we need to identify, we need to figure out how we rebuild the trust, how do we make sure that the industry is forward-thinking and trustworthy so that finance truly serves the function. And as the board and John looked at that, and then of course the next question was, who are we going to target to take this forward? And that was about the time I was going to retire, okay, and come back to US from my assignment in Hong Kong. And so my retirement got extended for 3 years. And here I am. And I must say that I have an outstanding team of people within CFA Institute having done a marvelous job. And probably the name that you've heard the most is Rebecca Fender, who leads our team. And my job is really to support them in every way that I can. And so, first question that came up was, well, what does this mean to build trustworthy, forward-thinking industries? You know, how do you do that? What are the issues? And one of the things that I did was I went to probably about 15 different countries, do it what CFA does the best, which is our CFA program, if you think about it, is built by talking to industry leaders in terms of what they consider relevant. Well, we did exact same process with Future of Finance, saying, what does this mean? So we talked to people like Mr. Bogle, talked to people like Dr. Martin, and we counted that we talked somewhere in the range of 250 to 260 individuals, which led to arriving those 6 pillars or 6 themes of Future of Finance in terms of what all these thought leaders throughout the globe consider absolutely relevant, absolutely critical. And the number one, of course, came out was putting interest of the client first. And then we decided to create an advisory council of thought leaders, people who are highly respected. And so we came up with the name of 15 individuals. We had a B list in the event if any of those individuals decline, and most people thought that we should expect at least half of them to decline. Believe it or not, all 15 accepted. And John Taft, one of our member of the advisory council. So I met him for the first time in our first meeting in New York City. And we started talking about this whole concept of Future of Finance and what we're trying to do. And John was also thinking at the same time about this book. And one of the questions as I read his book that comes to my mind is, yeah, we all can talk about how crisis occurred because of the leverage and other excesses in the industry. But the question that often comes to mind is, what about the culture of the people who work in finance area? Was there something that drastically happened that led to all this change behavior? So I'd like to, first start out by asking that question to John, to say, John, talk to us about the culture of the finance and where we need to go.
Happy to do that. Good afternoon, everyone. Nice to be in Atlanta. I lost my connection here when my mother passed away in 2006. She spent the last 20 years of her life having come down here to get sober, which she succeeded in doing, lived for 10 years in Vinings, and then moved up. I'm told this is where the population growth is, north of town, actually a small town, Waleska, Georgia, which is about 10 miles or so north of Canton. So I used to come down here. She was on a farm. She had 100 animals. She grew up in Switzerland during World War II and always wanted to be Heidi, the goat herder. So she had 25 or 30 goats with Swiss bells on them that would tinkle around her farm in northern Georgia. But when she passed away, I haven't had as much of an opportunity to come down here. On a whole issue of culture in our industry, obviously a critical issue. When I run my firm is a wealth management firm. I've had three, just so you know who I am. I wanted to be a newspaper reporter, was a newspaper reporter, went back to graduate school, and have had 3 10-year stints in our industry. One as an investment banker in the public finance department, structuring municipal bond investments. One as the CEO of an asset management firm, a mutual fund and institutional asset manager. And then the third running wealth management business, which is retail brokerage. That's the modern day term for wealth management, which I do today for the Royal Bank of Canada in the US. And I've said all along, I think culture is everything. It's not enough to succeed. It's not enough to have the right culture, but if you don't have the right culture, nothing else is possible. You absolutely have to get culture right. My first book, which I wrote, which was published in 2012 by Wiley, Jack Bogle wrote the foreword, Charlie Ellis wrote the afterword, was called Stewardship. And the whole book was about culture. It was about culture as it relates to what I think the core principle underpinning our industry ought to be, and that is stewardship. There are lots of different definitions. It's a religious word, it's a secular word, but the definition you find in Wikipedia, take it for what it's worth, is responsibly managing what others have entrusted to our care. And I think that sums up what the financial services industry ought to be about. The underpinning of our industry ought to be the core principle of stewardship. And frankly, what we did was we lost sight of, and we got away from that core principle in the years leading up to the financial crisis, and I think it was a major, not the only, but a major contributor to the problems that we had. Just to help Ashwin segue to the next part, so I was one of obviously many people during the first 5-7 years after the crisis to be looking backwards, pointing fingers, assigning blame, engaged in sort of forensic deconstruction, what went wrong and why. When I walked into the meeting room for the Future of Finance initiative, what I saw and heard aligned with what I thought we needed to start doing, and that was stop looking backwards and start looking forwards and start having a forward-looking and constructive conversation about what do we need to do to have finance, broadly speaking, the financial markets, financial sector, financial firms, people who work in the industry be forces for good, i.e. support positive social outcomes instead of creating the kind of havoc we created in the mid-2000s. And that, it was really sitting in the meeting and watching other like-minded folks and seeing the CFA gear up behind that constructive, forward-looking conversation that galvanized me to write the book that some of you, I guess, have received today.
Thank you, John, for mentioning it. As you all know, that when you read about the future of finance, it talks about what we're going to do forward thinking. It doesn't go back to the past. As a matter of fact, we hardly ever talk about what led to the crisis. That's already passed, that's given, we need to move forward. And in the area of rebuilding trust, which is something that you constantly hear, fiduciary responsibility and fiduciary standard.
Right in there. Second question asked.
That's the most debated issue today. Industry is spending lots of money trying to water down those standards. And the question becomes, what should be the fiduciary standard? Should there be a uniform standard? And what are your perspectives on that?
Okay. I am a cocktail party bore on the subject of the fiduciary standard. I chaired the Securities Industry and Financial Markets Association in 2011. Leading up to that, I chaired the Private Client Committee of SIFMA, and as chair of the Private Client Committee, got the securities industry, the brokerage firms in America, and the asset managers, who, by the way, were deeply concerned about this issue to agree to unanimously and unambiguously support a fiduciary standard of care for any investment professional offering investment advice to individuals about their wealth management activities. That position was codified in the Dodd-Frank Act, Section 913, and I sat in front of Barney Frank's committee, and Barney Frank endorsed my first book and testified in support of Section 913, what became Section 913 of the Dodd-Frank Act, which gave to the Securities and Exchange Commission, which gives to the Securities and Exchange Commission the right, the authority, but not the obligation to write a fiduciary standard of care for investment professionals who offer advice to individuals about their securities portfolio, their wealth management activities. So it gets my juices flowing when I hear that the industry is trying to water down the fiduciary standard. The industry has supported unambiguously a fiduciary standard of care for all wealth management activities. And now, what's happening? How many people would consider themselves to be reasonably knowledgeable in this room about the fiduciary debate that's going on today? Okay, so I'll just summarize quickly. You have investment advisors, whether they work for asset management firms or they work for RIAs or they work for brokerage firms that are duly registered as investment advisors, operating under principles that have been built up through 40 Act activities that we know as the fiduciary standard today. The 40 Act fiduciary standard. It's actually not in the 40 Act, but it's built up around 40 Act fiduciary standards. Then we have 913, Dodd-Frank, that gives the SEC the authority to write a new or to bring the 40 Act fiduciary standard over to or do whatever they want in extending fiduciary responsibilities to activities that aren't investment advisory activities. Okay, so that means any and all other brokerage activities that relate to individuals could one day be subject to a fiduciary standard if the SEC got on its horse, figured out how to do it, and wrote such set of rules. And then thirdly, you have the Department of Labor, which has just recently reproposed original rules, withdrawn, rewritten, now out there for public comment, that would have proposed to extend ERISA fiduciary standing to anybody who talks to clients, to individuals about their retirement accounts. Most specifically and dramatically IRAs for the first time. Moves ERISA fiduciary rewritten rules to IRAs. So the original vision that we had that let's, as a matter of public policy, move from multiple state suitability, ERISA, and 40 Act rules for advising individuals, which they don't understand. They don't know which one applies to whichever firm or advisor they're talking to. And let's just have one standard. So no matter who an individual talks to, they're covered by that standard, and it's a fiduciary standard. That was the policy thrust behind Section 913. But now we have the worst of all worlds, ERISA fiduciaries that applies to retirement accounts, 40 Act fiduciaries that applies to discretionary accounts, suitability standards as it applies to brokerage accounts, and some state standards for insurance advisors who engage in various activities. It's a hodgepodge, a melting pot, and none of it makes any sense. So that's where we sit today. And the situation is, it's broken. What the DOL has done, in my opinion, breaks it worse than it was broken before. And it's a mess, and we have a long way to go before we get to where the investing public deserves to have us get to, which is a single, uniform fiduciary standard of care for anybody who is providing advice. And why can't we agree on it? It's the old devil is in the details. And boy, is it ever.
You know, you would have expected John to give an answer which is straightforward and not a politician answer, even though he comes from a lineage of politics. For those who don't know, his great-grandfather was President of the United States. His grandfather...
I had nothing to do with that.
His grandfather was a senator and known as Mr. Integrity. And of course his father, an academic. All academics have high level of integrity. And so John comes from two aspects. One, integrity, and second, the culture of service. You know, that's in his family. And he has a better understanding of policy making. To that end, you know, Sheila Bair and others in your book talks about where we are in regulation, you know, Frank Dodd Act and all other acts. Question often people have we done enough, number one? Are we there? Is system better today? And second question, and I'll quote, I just wrote down today as I was reading, that our FDIC chair talked about how we have the regulation, we just do not have the political will to enforce it. Can you comment on?
Okay, yes, I'd be glad to. Thank you. The book, I'm gonna say first of all, the book is made up, those of you who have it, of contributions from about 21 different authors, and each of them address what I call a different stepping stone on the path to enlightened finance, which we can get to. And about half those stepping stones have to do with the blocking and tackling of regulatory reform. So the answer is, post Dodd-Frank, post Basel III, have we done enough to fix the shortcomings in the infrastructure of financial regulation that created the excesses or allowed the excesses to build up that caused the last financial crisis? And the answer is no. Have we done too much? The answer is yes. We've done too much of some things, not enough of other things. The one thing that the Dodd-Frank did right, I believe, was that it didn't try to hardwire into legislation all the things that needed to be done. It gave to regulators, delegated to regulators, the responsibility for writing the rules of the road. And given the emotionality that was prevailing at that time, I mean, they were hanging, financial effigies outside the Capitol, and that was the Sachs and the Shitty hearings in front of Carl Levin. I mean, the fact that we got a bill that was even reasonably constructive was, I think, good news. But it means that ever since, regulators have been toiling away at trying to implement the provisions of Dodd-Frank, and we're only halfway through implementing what's in that rule alone. Meanwhile, the financial services industry is evolving in front of our very eyes. There's business as usual regulatory rulemaking. What the DOL just did on fiduciary standard wasn't in any act. They just decided to do it, post facto. Come along, let's do something significant in the ERISA world. So a lot of that is going on. We haven't finished doing what Congress and international regulators told us to do. The system's evolving, so more needs to be done. We've, as I said, done too much in some areas, not enough in other areas. And having said all of that, do I believe, and do others in the book believe, that the financial system is safer, sounder, and more secure than it was going into the crisis? I think it's unquestionably more secure. there are probably two or three things that have made it more secure. More robust capital levels and less leverage, number one. You could attribute 80% of the increased stability, prospective stability of the system to that. Derivatives reform, central clearing and execution facilities to try to mitigate counterparty risk in the world of derivatives, another big contributor to more stable systems. But market structure reforms, which Mary Shapiro writes about, systemic risk related to the migration of risk out of regulated sectors of the financial system into unregulated sectors of the financial system, where activity and assets now exceed what they were going into the crisis. Supposedly, the Financial Stability Oversight Council has the ability to look into the shadow banking world and say excesses are building up in non-bank lending to subprime borrowers. We're going to focus on that and regulate it. But are they doing enough of that? Is the radar finely tuned enough? Is the policy response quick enough and flexible enough to do something about those excesses? We don't know yet. But all that is going on, and let's not forget, every day the financial system is more interconnected and more complicated than it was the previous day. Complexity and interconnectedness means anytime you have a shock to the system, the shock spreads faster, goes deeper, causes more potential instability than it did in a simpler, less connected system. And Nicholas Taleb has written about that. So we have to keep up with the financial system that's evolving. It's never going to be over. And I think we're better off than we were, but the job isn't done and it won't be done. And a number of the people in the book write about what needs to be done.
That brings up the question, and one of the pillars of future finance is knowledge. When you think of a profession, think about doctors, think about lawyers, think about accountants. They all have a standard of education that is absolute minimum required, followed by examinations, licensing examinations, which are very rigorous in nature, before they can actually practice. You go into the finance area and you take Series 7, which probably a high school graduate can easily pass. Do you think...
My son struggled and he graduated from Yale, so I don't know.
Do you think that we as in order for us to call profession, in order for us to make sure that we are truly servicing our clients, that our education requirement deserves us to be called professional?
I think you've put your finger on one of the big issues, and that is that I've been in this industry for over 30 years, and I'm just going, it's been, different areas have evolved at different rates, but it's been on a gradual, sometimes imperceptibly slow path of evolving from whatever it was, so merchandisers of unsuitable product to unsuspecting investors, I don't know, to more of a profession today than it's ever been. But we aren't a profession fully in the same way that doctors are, lawyers are, accountants are. We haven't fully professionalized our industry. And I think that creates a number of the problems, has created and contributed to a number of the problems in the industry. There's one of my favorite sections in the book. A mentor of mine and a supporter throughout has been Charlie Ellis, who I think is one of the most remarkable people I've ever met. There's a little section in the book. This is a slightly different point, but it's going to be, but I think it's equally important. And it's in a chapter that he allowed me to adapt from his book on what makes partnerships great, I think, or just, I forget what it's called, but it's about excellence, what contributes to it. And the section is about Goldman Sachs. I'm sorry if anybody is at Goldman Sachs. By the way, Bill George, who's on the board of Goldman Sachs, endorsed the book, so they're not too upset about it. But Charlie talks about the mission drift that went on at Goldman Sachs and how that contributed to their issues. But in it, he talks about the fact that people who interact with the financial services industry aren't always clear, and we are not always clear with them about what our relationship is to them. Okay, so are we fiduciaries to them as clients? Are we, merely market makers, or are we merely counterparties? So the obligations we have to the people we interact with in the world are different, kind of in a declining scale of fiduciary obligation, if you will, whether we're fiduciaries, market makers, or counterparties. And the person who tried to make this point was Lloyd Blankfein in front of Carl Levin's committee at that crazy time, and he got eviscerated, right? There's no way to make that point in a public session cleanly. But it's an important point, and it goes along with this professionalism. When are we professionals and when aren't we professionals? And do our clients and customers know the difference? And do they protect themselves accordingly? And the answer is no.
Yeah, that reminds me about your book on stewardship. And if there was one page that stood out to me was that word gram that you have in there.
Yeah.
And for those who've seen the book,
that was yours. That was the CFA Institute's. That's why it stood out.
And basically what it is, asking everyone to say, if you had to describe finance in one word, what would that be? And when you look at that diagram, with the size of the word, depending on how often it was repeated, it talks about it being crooks or untrustworthy and so forth. And I think about, I have now a grandson, and I look at him and say, if my grandson, when he gets old enough and comes to me and says, Grandpa, I want to go into this profession, how would I respond? And what you were talking about in terms of Charlie Ellis's book refers to that Winning the Loser's Game, I believe was the title of that book.
That's one of his books.
Right. And when you think about it, people also talk about our industry has moved from servicing industry to a transaction industry.
That would be Jack Bogle's.
So when you take all that aspect of the investment philosophy in terms of what Bogle talks about it in your book, what Charlie Ellis talks about in your book, in terms of how we have moved away from that responsibility to our client to this transaction-oriented business, and we're not thinking long-term. Can you shed light on it?
Well, there's a lot of good writing that I didn't. I'm sorry. There is a chapter in the book by Mark Wiseman, who chairs the Canadian Pension Investment Board, and Dominic Barton, the managing partner of McKinsey, and they just hosted a seminar in New York on long-term investing, and of course that gets at one of the ills that Jack Bogle has been inveighing against for years, and that is the increasingly short-term focus of our industry. In the book, there's a chapter by Roger Martin, the dean of the Rotman School, where he talks about short-termism in the construct of executive compensation, which he believes is being tied to, relatively recently, stock price of the companies that executives work for has created short-term and speculative focus for executives as opposed to real markets long-term focus. I mean, a lot of people are writing about all of this. Now, on the other side, though, in 1981, I started working in the financial services industry. By the way, my father was a nuclear physicist. He was the dean of Yale University, and he believed that if you spend 1 minute a day thinking about money, you had wasted your day. He literally thought it was something that was beneath him and beneath anybody to worry about or think about. Pursuit of the truth. And I can remember him sitting, I haven't told this story to Steve Schwartzman, whom I just spent some time with, but sitting, reading the New York Times profile of Steve Schwartzman, who was a student at Yale in the residential college where my father was master for a few years, when he was an investment banker at Lehman Brothers, and he literally threw the New York Times at me and said, "You're not going to be like that, are you?" And so part of the way I think of my career in financial services is to say to my dad, no, I'm not going to be like that, or what he perceives Steve Schwartzman to be like at the time. He's actually, pretty remarkable guy. And I've totally lost the question you asked me, but maybe you can reground me on this subject. Oh, no, what I was going to say is, so in 1980, I entered the financial services industry really completely green behind the ears. I was a newspaper reporter. I wanted to get into the industry because I'd covered the rebuilding of the city of Lowell, Massachusetts. It's a burned out industrial city that was remade through the visionary work of corporate leaders, political leaders, not-for-profit leaders, and the National Park Service, which designated the city of Lowell a National Historical Park. It's privately owned inside the park boundaries, but it has an interpretive center. It has the Lowell National version of Smokey the Bear Rangers in it. And the city was reborn. I thought, that's what I want to do. I went back to business school, got a degree, and went into public finance so that I could help public governments get involved in projects like that. I thought I was getting involved in finance not to be like Steve Schwartzman, but to make a difference in the world. And that's when I go back to the old timers in our industry and I say, what's changed? That's what they point to. So I thought I was entering the industry to do something noble, to help the world in one way or another. How far have we come from that? On the other hand, if you look at the stockbroker of 1980 and the stockbroker, the wealth manager of today, it is night and day difference. The level of professionalism, the process that person goes through, which is the equivalent today, if they're doing their job right, of taking a patient's discovery before they, before you prescribe medicine to them. You actually ask them, have they ever had heart disease, cancer in the family, all of that. That all goes on. You have people who have invested in their professional education, multiple degrees and designations. You have processes and support for the wealth management industry today that if you're moving along a path between sales and fiduciary, these investment professionals today are 9/10 of the ways towards being full-fledged fiduciaries for their clients. So the industry is this hodgepodge of we've lost touch with some of the things we should have stayed in touch with, and yet we've made progress in other areas in becoming more professional. It's an odd set of cross currents. In some ways we're better than we've ever been, and in some ways we're worse than we've ever been.
As we think through it, we talked about importance of speculation. We talked about the critical aspect of long-term in terms of and putting interest of the client first. Talk to us about this long-termism from the perspective of, call it universal owner, as John Rogers uses the term, or the super fiduciary.
That was one of my favorite chapters in the book, is a book contributed by John Rogers, the former CEO of the CFA Institute, on fiduciary capitalism, which is his perspective that as we get these long-term universal owners like sovereign wealth funds with broad mandates to behave in a way that improves the interests of the people of Norway or the people of Singapore or the people of China forever, over many generations, that they now they own all externalities, and when making investments in private enterprises need to take into account the long-term effect of any secondary or tertiary effects of the activity they're investing in. And he sees these universal owners as a powerful force going forward in demanding different kinds of behavior from private parties, and I agree with him. In my world, which is the world of wealth management, one of the fastest growing areas is the interest in ultra high net worth individuals right now, more than high net worth and affluent individuals, in the same type of socially responsible investing. And there seems to be on the part of asset owners that if we don't start to invest our money in enterprises that have a stewardship culture with respect to the physical world, future generations, and clients, customers, employees, and communities, in addition to shareholders, we are not going to survive on the planet. And I see this as an incredibly powerful force for transforming the financial industry potentially over the next 1 or 2 decades. It's already changing it.
Yeah, that brings to this idea of thinking about stakeholders, thinking about community. And asset managers often are conflicted when their client investors demand performance. How would you deal with that?
Well, I'm going to end on this point, and if you will, and when you're an investment advisor, an institutional investment advisor, and you walk into a client, you know what you are capable of delivering, what your process looks like, and what kind of returns you can reasonably expect to deliver for the client, relative or absolute. And then, if you have a productive meeting with a client, you interview them as equally as they interview you about what their expectations and needs are. And then the successful relationship where you as a financial services firm or individual can add value over time to that client exists when the needs and expectations of the client are aligned with your capabilities. Then you have a match made in heaven, and you can actually point to success over time. The same is true of finance in society, and that's where this concept of enlightened finance and the big ideas in the book, and the last half of the book is really the big idea portion, is that until and unless we have alignment between what society wants and what finance is delivering, we're not going to have finance be a force for good. We're going to have a disconnect. And what happened, I think, in the financial crisis is it was kind of a dividing line. What we thought we wanted from capitalism, which was growth at any at all costs, even if it comes leveraging up the world's balance sheets, running up deficits in public finances, whatever. We want growth at any at all costs. Whoops. That's not what we want anymore. Well, what is it that we want? And right now, there's a conversation going on about what do we want from capitalism? Why is that important? Because until we know that, finance can't enable that. Finance is an enabler of economic capitalism. So what do you want from capitalism? Do you want growth at any and all costs? No, we don't want that. We saw what happened. Well, what is it? So David Brooks uses the word social capitalism, wrote a column about growth balanced with other things. Mark Carney, the governor of the Bank of England, uses the word inclusive capitalism, growth balanced with other things. John Rogers, fiduciary capitalism. David Blood, sustainable capitalism. John Fullerton, regenerative capitalism. These are all modifiers put in front of the word capitalism to try to start talking about what we want from the economic system and therefore what the financial system needs to do. And the shortest answer I can give you today, after participating in the Future of Finance initiative, talking to all these smart people, is that we no longer want growth for growth's sake. We want growth balanced with stability, which has implications for how we regulate the financial system. We want growth balanced with sustainability. We want growth balanced with generational equity, and we want growth balanced with inclusiveness. not generating huge disparities in wealth. We want growth, in other words, in the service of other social goals. Growth always, because without growth there's nothing. But growth in the service of and beside and in support of other goals. Once we get that straight, then we can start drawing a diagram for what the financial sector ought to work like and look like in support of social, inclusive, fiduciary capitalism and growth balanced with other things. And I think this is an exciting time in the history of our industry, and I'm happy to take questions on the sublime or the particular, wherever you want to go. Sir. Robo-advisors, if you will, algorithmically driven, online, either light human or no human touch models. I think they're both potentially, well, they're transformational. I think they will be transformational for our industry. I think there are good things about them. I think they will, if nothing else, they will force firms like mine, more traditional human advice firms, to digitize, develop more robust channels for communicating differently with clients, and they will put fee pressure on our industry. It will lead to fee compression even beyond what's going on today. And it will probably engage millennials who seem to relate to that form of advice more in managing their wealth than our model seems to be able to do. So I think all that's good. I also think it's a bull model market. In other words, as long as markets have reasonably stable, positive returns, those type of computer-driven models are fine. When the market is down 50%, you look at your statement, you can't believe that your retirement account was worth half of what it was a month ago. It could exacerbate, all the things you see in a crisis, because there's nobody to go to and validate or get, check off against. But they're here. They're going to change our business, and we're certainly looking to incorporate it. Don't quite yet know how to do it or where to use it, but it will be a different firm because those models have been developed. Sir. Well, one of the things that allows me to speak, talk, and write the way I do is that I work for a firm, a Canadian bank, that is a model. I mean, look to the Canadian banks for the way financial firms should have behaved during the crisis. Now, there were technical reasons for that, the mortgage market in Canada. There were regulatory reasons for that. The Canadian regulators are more conservative. But there are also cultural differences, and that is Canadians are more behave and act and think like stewards. You have 40 million people, fewer than in the state of California, in one of the most resource-rich and largest land masses in the world. They just don't screw it up. I mean, that's all you have to do if you're Canadian. And I wrote a chapter in my first book on well, I'm married to a Canadian. I work for Canadians, mostly like Canadians. Married to a French Canadian. That's a special class, by the way. That's right. It's like being married to a Cajun. There is a cultural difference, and they are more culturally aligned to being good stewards. They're patient. When in doubt, do nothing. That's a perfectly fine response in Canada. Whereas down here, it's just do it. And the expression, you can count on Americans to do the right thing after they've exhausted all other alternatives. So that's the way Canadians look at it. And the thing that drives us them crazy is they see this asymmetric reward expectation, which is that you want me to be successful, I'm going to go out and fail. Failure is the seedbed of success. I don't want to be punished for failure, I want to be rewarded for success. And Canadians look at that and go, what happened to the idea of, a balanced and proportionate reward system? You get punished for failure, you get rewarded for success. Just a different culture. And I think that contributed to the fact that Canadian banks and other financial institutions have performed better. Well, you can do that. And let me just give you an example of one way in which the industry has evolved in that direction. The single largest type of investment in the investment advisory accounts at my firm are ETFs. Okay, so not mutual funds, not stocks and bonds, ETFs. Why are they in there? Because they're a lower cost way to fulfill the asset allocation that the advisor holds up to the client as their value added today. Now, so that's just a step along the path towards what you're talking about, which is marrying potentially an even lower cost way to fulfill the investment advice portion of what an advisor offers to their client, than an advisory account with ETFs in it. So we go even one step down the value chain, the cost chain. And then the thing that the advisor charges for is all the life advice, how to structure the estates, how to, what kind of insurance policy should you own where, how do you think about liquidating various pots of money to be tax efficient in the withdrawal stage of your retirement. All of those things today are beyond the reach of, not much in the case of tax optimization of robo-advisors, but you could certainly see yourself heading in that direction. And in fact, that is what's going on. The investment piece of wealth management is becoming commoditized. The asset allocation and the fulfillment of that asset allocation today is no longer a differentiator. But you know what the simplest and most straightforward and most differentiating piece of advice is today that we offer to our clients? It's the relationship Ashvin and I have had for 40 years. I just talked to the manager of our Billings, Montana office, celebrating his 40th anniversary. He was sitting on the porch of his first client's house in Tucson, Arizona. Client walked in the door. They assigned it to the newbie, Bill Tierney. Go see Bill. 40 years later, the client bought their house, their retirement home in Tucson, Arizona, with the account that Bill had been managing for him for 40 years. And I thought, there is the value of the wealth management advisor model right there. It's that long-term, consistent, continuous relationship. And I go to parties and I sit down with our clients and they say, Ashvin, I don't know what I'd do without Ashvin. Takes care of everything for us. I trust him totally. I call those investor endorphins. Sleep at night. Don't worry. That is fundamentally our product. And how you get there, you have to price what you do reasonably, or your client will not trust you. You have to put together a program that performs consistent with the client's expectations, or they won't trust you. You have to communicate with them straightforwardly and honestly, and you have to provide consistent hand-holding over long periods of time. That's how you build that kind of trust. That is and always will be the key product of the advisor business. Now, everything else is going to get commoditized and the costs will get driven down. The average ratio of revenues to assets under management, the firm I run, is 60 basis points, 0.6%. This is for clients with $250 to $3 million in investable assets. That number would have been 1.5% a decade ago and north of 2%, where it is today in Canada, by the way. The average expense ratio on a Canadian mutual fund is north of 2%. So you can see that over long periods of time, the industry's become more cost effective for clients. Could we go further? Absolutely. At what point do you we play this funny video where a guy negotiates to have a tooth pulled, and he says, well, what if I don't, and the guy says, $2,000 to have your molar pulled. He says, I don't want that. What if I don't have any Novocaine? $1,500. What if I use a pair of pliers instead of, forceps? $1,000. He finally gets it down to $250. He goes, okay, that's about what I was expecting to pay. And then he turns to the camera and he says, now, I'd like to make an appointment for my wife. So at what point does paying $250 outweigh, the benefit of the service you're getting? All the smart people that I read, and I was going to write a piece called 50 Shades of Pessimism, because I read a number of pieces, including, you want to slit your neck, Jeremy Grantham, and GMO. It's just, oh God. But everybody says, Jeremy Grantham's projection for future growth is 1.5% going forward versus 3% historical. You can make a very good case that is going to be the growth rate going forward. I have no idea whether he's right or whether human ingenuity, technological process, who knows what will debunk that, and maybe we're headed into a global age of growth. But here's what I would say to anybody: you need to prepare for that possibility, because there at least is, sitting here today, a significant chance that 1.5% growth going forward is going to be what we see. For GDP growth, and then reduced returns on all asset classes as a result of that. Will it put pressure on our industry? Absolutely. How? Probably long-only stock and bond strategies will need to be replaced with more alternative approaches, because clients will be looking for something better. And secondly, it'll put fee pressure. There's no way you can charge 1.5% for an advisory account that's earning 1% real nominal returns going forward. So I think it's going to push us even faster in the direction we're already headed.
For those, many of you already have the book. If you don't, I highly recommend you read the book. It's very enlightening for looking at enlightening finance, as well as his earlier book on stewardship. I think it talks about the culture. And I think it's very important that we understand the concept of culture, because culture is what makes us all. And we as a charter holder, we go by the highest level of principles. But the critical part is, it is beyond you to others. How can you spread the word? How can you make influence to others in terms of what you do? And I think that's also important, because the idea is not just among us here in the room, but think from the perspective of your friends, your colleagues, people who work in your firm. How can you make sure that you also provide for the culture that's necessary? So thank you all.
Thank you.